Now, when it comes to the business itself, we think we are subscale against the big players in the US and in the rest of the world.
The news that Airbus, under CEO Guilherme Faury, has made the pivotal decision to cease sales in the United States has sent ripples through the international aerospace industry and the broader world of global trade. This announcement comes in direct response to sweeping new tariffs introduced by the newly elected U.S. President Donald Trump, whose administration has made clear its intention to leverage import duties as a tool to reassert America's economic position. The effects of these new trade policies have quickly become tangible, as seen by Airbus's dramatic move, a step that many believed unthinkable only a short time ago. Before we start, smash the like and subscribe buttons for more updates. At the heart of this development lies the long-standing economic relationship between the United States and Airbus, the European aerospace giant. For decades, Airbus has been a formidable competitor to Boeing, America's own aerospace champion in the fiercely competitive global market for commercial aircraft. The United States has always represented not just a lucrative market for Airbus's commercial airplanes, but also a vital battlefield for prestige, innovation, and technological advancement. Airlines across America, both major carriers and smaller regional operators, have looked to Airbus's lineup of aircraft to meet the growing demand for fuel efficiency, passenger comfort, and cutting-edge avionics. The abrupt halt in sales signifies a tectonic shift not only in market dynamics but in the psychology of international trade. The tariffs imposed by the Trump administration are not incremental. They are sweeping, affecting a vast range of imported goods, with particularly heavy emphasis on products from countries seen as economic rivals, or whose trade practices the U.S. deems unfair. Airbus, being a European conglomerate with deep roots in France, Germany, Spain, and the UK, falls squarely within the crosshairs of these new policies. For CEO Guilherme Faury and his leadership team, the calculation quickly became one of simple economics. The tariffs would push Airbus's aircraft far beyond a price point that American customers would accept. To continue selling in such an environment would mean either operating at a loss or being relegated to an irrelevant niche, neither of which is viable for a company of Airbus's stature. This moment, then, is not just about the actions of one company, but is emblematic of a broader reconfiguration of how global commerce operates in the face of protectionism. The Trump administration's tariffs are designed to stimulate domestic manufacturing and give American companies a distinct advantage on their home turf. The logic, as articulated by supporters, is that by making imported goods prohibitively expensive, American carriers will have no choice but to turn to Boeing and other domestic manufacturers for their fleets. This, in turn, should create jobs, boost local economies, and restore a sense of self-sufficiency that resonates with Trump's broader political agenda. However, the implications of Airbus's withdrawal extend far beyond the simple arithmetic of market share. First and foremost, the decision is a major blow to competition within the U.S. aviation sector. Airlines in the United States have benefited immensely from the presence of two world-class aircraft manufacturers vying for their business. This competition has driven down prices, accelerated innovation, and allowed airlines to negotiate more favorable deals, ultimately benefiting consumers with lower fares and improved flight experiences. With Airbus stepping back, Boeing stands as the uncontested leader in the American market, at least for the time being. While this might appear to be an immediate win for Boeing, it raises serious questions about complacency and the loss of the competitive pressure that has historically driven excellence on both sides of the Atlantic. Another crucial aspect to consider is the disruption to the global supply chain. Modern aircraft are not made in one place. Rather, they are the product of an intricate web of suppliers, manufacturers, and assembly lines spread across continents. Even within the U.S., Airbus has invested heavily in American facilities, particularly in states like Alabama, where the company's assembly line has created thousands of jobs and contributed to local economies. The tariffs complicate these investments, as components manufactured in the U.S. may now be cut off from integration with Airbus's broader operations. Conversely, American suppliers that provided parts to Airbus will find themselves locked out of a lucrative customer base, potentially leading to layoffs, factory closures, and a retraction of business activity in affected regions. The economic implications ripple outwards. Airlines that have planned their fleets around a mix of Airbus and Boeing aircraft will now face difficult choices. The sudden unavailability of Airbus planes in the U.S. market will force carriers to reassess their long-term strategies, potentially resulting in delayed fleet renewals, increased operating costs, and disruptions to expansion plans. Airlines that were relying on Airbus's next-generation fuel-efficient models to reduce costs and meet environmental regulations will have to look for alternatives, possibly at higher prices or with less optimal features. The domino effect can extend even to passengers who may see fewer new planes entering service, less choice in flight experiences, and higher ticket prices as airlines grapple with reduced competition and fewer negotiating levers. For Airbus itself, this marks a painful but perhaps necessary adaptation to the new reality. CEO Guilherme Faury has made it clear that Airbus cannot simply absorb the punitive tariffs and continue business as usual. The move to halt sales is a signal both to the U.S. administration and to the broader global business community that there are limits to what even the largest and most resilient multinational corporations can endure. For Airbus, the U.S. market has long been a pillar of its global strategy. With that avenue closed off, at least for the foreseeable future, the company will have to refocus its energies on other markets: Asia, the Middle East, Africa, and Latin America, while also seeking ways to innovate around the obstacles presented by protectionist policies. Diplomatically, the move introduces new tensions between the U.S. and its traditional allies in Europe. For decades, the transatlantic relationship has been defined by a mix of cooperation and rivalry, particularly in high-tech industries like aerospace. The Trump administration's tariffs and Airbus's subsequent retreat are likely to be seen in European capitals as a provocation, one that may prompt reciprocal measures or further sour relations at a time when international cooperation is more necessary than ever. The fallout could extend into other sectors as countries retaliate with their own tariffs, creating a spiral of protectionism that chokes off the free flow of goods, services, and ideas that has defined the global economy for generations. For American workers and businesses, the initial response may be one of optimism. The logic is straightforward. With Airbus gone, Boeing and its supply chain partners will have more business, leading to more jobs and economic growth. However, the reality is more nuanced. Without competition, there is less incentive for Boeing to innovate or keep prices low. Moreover, the supply chain disruptions caused by the tariffs could actually hurt some American businesses that relied on Airbus as a customer. In an interconnected economy, the impacts of such a major shift are rarely confined to one industry or one side of the ocean. Politically, this development is a vindication of President Trump's approach to trade. Throughout his campaign and into his presidency, he has made economic nationalism a cornerstone of his platform. The decision to impose sweeping tariffs is consistent with his rhetoric and his promise to protect American jobs and industries. For his supporters, the withdrawal of a major foreign competitor is proof that tough trade policies can produce real results. For critics, however, the move is likely to be seen as short-sighted and potentially damaging to America's long-term interests. The loss of competition, the potential for retaliatory measures, and the disruption of global supply chains are all risks that could outweigh the immediate gains. Looking beyond the immediate impact, this event signals a possible shift in how international companies approach the U.S. market. The United States, for decades, has been seen as an essential market for any company with global ambitions. The sheer size of the American economy, its wealth, and its appetite for high-quality goods have made it a magnet for investment, innovation, and trade. If a company as large and influential as Airbus can be forced out by protectionist policies, other companies may begin to rethink their own strategies. The perception of the U.S. as an open and predictable place to do business may be eroded, leading some firms to redirect their energies elsewhere. There is also a broader philosophical question at play. The rise of protectionism, as exemplified by the Trump administration's tariffs, challenges the fundamental assumptions that have underpinned global trade since the end of World War II. The post-war order was built on the idea that open markets, free trade, and international cooperation were the best paths to prosperity and peace. By making it too expensive for foreign companies to compete, the U.S. risks turning its back on those principles, with consequences that may be felt for years or even decades to come. Within the corridors of Airbus's headquarters, the decision to withdraw from the U.S. market cannot have been taken lightly. The company's leadership, led by Faure, faces the daunting task of not only managing the immediate fallout, but also charting a new course for the future. Airbus will have to reassess its global strategy, strengthen relationships in markets less affected by U.S. policy, and look for ways to mitigate the financial impact of losing access to such a critical customer base. This may involve stepping up investment in regions where trade barriers are lower, pursuing partnerships with airlines in rapidly growing markets, and accelerating innovation to maintain its technological edge. Meanwhile, the global aerospace industry as a whole will be watching closely. The competition between Airbus and Boeing has driven advances in aircraft design, fuel efficiency, safety, and passenger comfort. With one of the key players now absent from the American stage, the dynamics of innovation could shift. Boeing may find itself with more breathing room, but without the constant pressure from a rival, the pace of progress could slow. Other companies, both established players like Embraer and newcomers from China and Russia, may see opportunities to fill the void left by Airbus. The end result could be a more fragmented and less dynamic industry, to the detriment of airlines and passengers worldwide. From the perspective of international relations, Airbus's withdrawal is likely to be interpreted as a symptom of deeper challenges facing the global trading system. Trade wars, once thought to be relics of a bygone era, are now a reality. The willingness of the U.S. to use tariffs as a tool of economic policy signals a move away from the multilateralism that has defined international economic relations for decades. Countries and companies alike will have to adapt to a world in which access to markets can no longer be taken for granted and in which political considerations increasingly trump economic logic. The response from European governments is also a significant factor to consider, as Airbus is not just a private corporation but also a symbol of European industrial strength. Its exclusion from the U.S. market is a national, even continental issue. European leaders are likely to seek ways to support Airbus, either through increased government investment, support for research and development, or by seeking new markets for its products. There may also be efforts to challenge the U.S. tariffs through the World Trade Organization or other international bodies, although the effectiveness of such measures remains uncertain in an era of rising nationalism and declining faith in global institutions. For American consumers, the implications may not be immediately obvious, but they are no less real. The end of Airbus sales means fewer choices for airlines, which can translate into less innovation, fewer amenities, and potentially higher costs that are passed on to passengers. Over time, the effects may become more pronounced, as airlines struggle to find suitable replacements for Airbus aircraft, and as Boeing's monopoly in the U.S. market leads to a slower pace of progress. The psychological impact of this event should not be underestimated. For decades, the U.S. has positioned itself as the champion of free markets and open competition. The withdrawal of a major foreign competitor like Airbus, driven by government policy rather than market forces, represents a break with that tradition. It sends a message to the world that the rules of the game have changed, and that success in the American market is no longer a matter of quality or innovation alone, but of political calculation and the ability to navigate an increasingly protectionist environment. The landscape of international business is often defined by the constant push and pull between protectionist impulses and the forces of globalization. In the wake of Airbus's momentous withdrawal from the U.S. market, driven by the newly imposed tariffs from President Donald Trump's administration, the intricate network of relationships, dependencies, and strategies within the aerospace sector is experiencing unprecedented strain. This event, though initially shocking in its abruptness, is now unfolding into a series of complex consequences that affect not just industry players, but government policymakers, regional economies, labor markets, and even the very structure of international commerce itself. The relationship between governments and multinational corporations has always been one of both collaboration and tension. Airbus's decision to pull out of the U.S. serves as a striking example of how political choices can override even the most robust business plans. For decades, Airbus meticulously cultivated relationships with American airlines, suppliers, and local officials. Its presence on U.S. soil, especially through manufacturing sites like the one in Mobile, Alabama, symbolized a commitment to partnership and mutual benefit. Now, with tariffs dramatically shifting the cost calculus, those ties are being tested like never before. On the American side, the impact of this sudden void is already being felt at various levels. The absence of Airbus planes from the options available to U.S. carriers is forcing airline executives to rethink procurement strategies that had long relied on the competitive tension between Airbus and Boeing. Airlines that had established entire fleet renewal plans based on Airbus's products, whether the single-aisle A320 family or the wide-body A350, are now confronted with a host of logistical, financial, and operational challenges. The process of retooling for a Boeing-only or mostly Boeing fleet is far from simple. It affects everything from pilot training programs to spare parts inventories, from maintenance procedures to future route planning. This process, disruptive as it is, does not happen overnight and carries a host of hidden costs that ripple through the industry. For US-based Airbus employees and suppliers, the consequences are intensely personal. The mobile assembly line, for example, had become a source of pride and economic vitality for the region, employing thousands directly and supporting many more jobs in the wider supply chain. These positions are now at risk as reduced U.S. sales volumes lead to inevitable cost-cutting measures and a retrenchment of operations. For American suppliers who provided key parts for Airbus's global production network, everything from avionics and wiring harnesses to landing gear components, the loss of Airbus as a customer presents an existential threat. Many of these suppliers had come to rely on Airbus contracts for their survival, and diversifying away from such a major partner is no easy feat in a specialized, capital-intensive industry. Meanwhile, the competitive dynamics in the global aerospace industry are beginning to shift in subtle but significant ways. With the U.S. market closed off, Airbus must reallocate resources, both capital and human, to regions where sales remain viable and trade barriers are not insurmountable. Asia, especially China and India, is likely to become an even greater focus for Airbus's sales teams, engineers, and marketing efforts. These markets, with their booming middle classes and rapidly expanding aviation sectors, offer considerable growth potential. However, they also present their own risks, ranging from local regulatory hurdles and competition from state-backed domestic manufacturers to the unpredictability of international politics. Airbus will need to maneuver carefully, building new alliances and investing in partnerships that reduce vulnerability to future trade disputes. For Boeing, the implications are equally profound. In the short term, the withdrawal of Airbus appears to grant Boeing a near monopoly in its home market. The company can expect a boost in orders from U.S. airlines that no longer have a European alternative. However, such dominance comes with pitfalls. History has shown that monopolies, whether state-imposed or de facto, can lead to stagnation, higher costs, and a decline in innovation. The relentless competition from Airbus was a primary driver behind many of Boeing's technological leaps, including the 787 Dreamliner and the re-engineered 737 MAX. With less competitive pressure at home, Boeing's own incentive to push the envelope in product development, pricing, and customer service may diminish over time. There is also the risk that a protected home market may breed complacency within Boeing's corporate culture, potentially leaving the company more vulnerable to competitive threats from unexpected quarters. International competitors such as China's Comac and Russia's Irkut are investing heavily in commercial aircraft programs. With Airbus now funneled into their markets, these competitors may find it easier to collaborate with the European giant, exchanging technology and building alliances that challenge Boeing's position globally. Such new alignments could reshape the balance of power in the global aerospace industry, tilting it away from the historical US-Europe duopoly toward a more multipolar future. For international airlines that operate globally, the new tariffs introduce additional complexity. Many large carriers maintain transatlantic routes, flying Airbus aircraft into and out of the US. The patchwork of tariffs, fees, and restrictions may create situations in which airlines must reconsider not only what aircraft to purchase, but also how to structure their networks, maintenance hubs, and long-term investment plans. The specter of trade walls could force carriers to develop regionally siloed fleets, leading to inefficiencies and a loss of the economies of scale that have been crucial to the growth of international aviation. Beyond the boardrooms and factory floors, this development is igniting debates about the appropriate role of government in managing trade and protecting national industries. Supporters of the Trump administration's tariffs argue that America's aerospace sector, as a strategic industry, deserves strong protection from foreign competition, particularly when that competition is perceived to benefit from subsidies or favorable trade policies back home. They see the withdrawal of Airbus as evidence that tough trade measures can have immediate, tangible effects, shifting the balance of power back toward American workers and manufacturers. Yet critics warn of the dangers inherent in such unilateral measures. The global economy is deeply interconnected, with goods, services, and capital flowing across borders in ever more complex patterns. Trade wars rarely have clear winners. Rather, they inflict costs on both sides, disrupt established supply chains, and create uncertainty that discourages long-term investment. By forcing Airbus out of the U.S. market, the administration may have set in motion a cascade of retaliatory measures that could affect not just aerospace, but other industries as well: agriculture, technology, pharmaceuticals, and beyond. The human cost of these disruptions should not be overlooked. For workers whose livelihoods depend on the smooth functioning of global trade, the sudden imposition of tariffs and the resulting job losses or uncertainty can be devastating. Communities that had come to rely on the steady presence of multinational corporations like Airbus may find themselves facing economic decline, with fewer opportunities for the next generation. In many ways, these communities are caught in the crossfire of geopolitical maneuvering, bearing the brunt of decisions made in distant capitals. Educational institutions and training programs are also affected by this upheaval. The aerospace industry is heavily reliant on a pipeline of highly skilled workers, engineers, technicians, designers, and managers, who often train for years to qualify for these roles. The partnership between Airbus and U.S.-based universities and technical schools has been a point of pride, creating pathways to well-paid, high-skill jobs. The withdrawal of Airbus may curtail these partnerships, leading to fewer internship opportunities, reduced funding for research, and a potential brain drain as students and graduates look abroad for opportunities. Environmental considerations form another crucial layer in this developing story. The aerospace sector is under increasing scrutiny to reduce its carbon footprint and develop cleaner, more efficient aircraft. Airbus has positioned itself as a leader in this movement, with investments in next-generation technologies such as hydrogen-powered flight, sustainable aviation fuels, and advanced aerodynamics. The absence of Airbus products in the U.S. market could slow the adoption of these innovations among American airlines, as fewer choices and less competition reduce the pressure to invest in greener fleets. In the long run, this could undermine broader efforts to decarbonize aviation, with consequences for climate goals both in the U.S. and globally. Financial markets are responding to the news with a mixture of caution and speculation. The shares of both Airbus and Boeing have experienced volatility, as investors digest the potential implications of a reshaped competitive landscape. Analysts are recalibrating their models, attempting to forecast the long-term impact of reduced market access for Airbus and the possible boost for Boeing. Yet, the complexity of the situation, laden with political risk, uncertain supply chains, and unpredictable consumer responses, makes accurate forecasting extremely difficult. In such an environment, volatility may become the new normal, affecting everything from pension funds to sovereign wealth portfolios. The broader diplomatic ramifications of this development are also significant. The transatlantic relationship between the United States and the European Union, while often contentious, has been anchored in a shared commitment to open markets, common security goals, and deep cultural ties. The use of tariffs as a blunt instrument to reshape trade flows threatens to erode that foundation. European leaders are already considering responses ranging from formal complaints at the World Trade Organization to the imposition of reciprocal tariffs on American goods. Such measures, if enacted, risk escalating tensions further and sparking a tit-for-tat cycle of retaliation that could ensnare other sectors and deepen divisions across the Atlantic. At a time when global challenges, from pandemics to climate change to security threats, demand unprecedented levels of cooperation, The shift toward economic nationalism and protectionism carries profound risks. The weakening of transnational alliances and the rise of zero-sum thinking make it harder to solve problems that do not respect borders. The fallout from Airbus's withdrawal is thus not just a matter of economics. It is also a test of the international order's resilience in the face of populism and unilateralism. Meanwhile, the response from other international players is being closely watched. Major economies such as China, India, Brazil, and Russia are likely to view the U.S. tariffs and Airbus's retreat as an opportunity to advance their own aerospace ambitions. For China in particular, the timing could not be more opportune. Its state-backed aerospace sector has made rapid strides in recent years, and the country is eager to position itself as a viable alternative to both Airbus and Boeing. By presenting itself as a welcoming market for Airbus's redirected efforts, China could accelerate its own technological development through joint ventures, technology transfers, and co-production agreements. Latin America, Africa, and the Middle East are also regions of growing importance for the aviation industry, with young mobile populations and a rising demand for air travel. Airbus may now intensify its efforts in these markets, offering aggressive financing packages, forming partnerships with local airlines, and tailoring its products to the specific needs of emerging economies. These moves may not fully compensate for the loss of the U.S. market, but they could help Airbus sustain growth and preserve its position as a global leader. On the policy front, the Airbus withdrawal is likely to shape debates about trade, industrial strategy, and economic security for years to come. Legislators and regulators in the U.S. are being forced to grapple with the unintended consequences of protectionist measures. While the goal of safeguarding American jobs and industries is politically popular, the collateral damage, from lost investment to strained international relationships, cannot be ignored. Policy debates are increasingly framed around the balance between national sovereignty and global integration, between protecting existing industries and fostering innovation, and between the short-term wins of protectionism and the long-term benefits of open competition. Within the U.S. political landscape, the issue has become a lightning rod for broader arguments about the direction of the economy. Proponents of the tariffs argue that they are correcting decades of unfair trade practices and creating a level playing field for American workers. Opponents counter that the measures are isolationist, self-defeating, and out of step with the realities of the modern economy. As the next election cycle approaches, the fallout from Airbus's exit is likely to be a point of contention in debates over trade, economic policy, and America's role in the world. In Europe, the decision is also sparking soul-searching about the region's industrial strategy and approach to global markets. European policymakers, facing the prospect of a U.S. market increasingly closed to their products, may double down on efforts to build up internal demand, foster innovation, and defend the continent's industries from external shocks. The possibility of a more assertive European industrial policy, focused on strategic autonomy and resilience, has become a subject of intense discussion in Brussels and national capitals alike. The Airbus episode is further prompting multinational corporations across all sectors to rethink their risk management strategies. The traditional approach, built on the assumption of relatively stable, predictable market access, is being replaced by a more cautious and flexible outlook. Companies are increasingly hedging against the possibility of sudden regulatory changes, supply chain disruptions, and political risk. For many, this means diversifying both their markets and supply bases, investing in redundancy and agility, and maintaining contingency plans for a range of scenarios that once seemed remote. The effects of this seismic event extend even to questions of national identity and pride. Airbus, as a flagship of European industrial achievement, has long been a point of pride for its stakeholders and employees. Its success in the U.S. market was not just a business victory, but a validation of the European model of collaboration, innovation, and competitiveness. The retreat from the U.S., while driven by external circumstances, is nonetheless felt as a setback, a reminder that even the most successful international enterprises are vulnerable to shifts in political winds. Conversely, for some in the U.S., The departure of a major foreign competitor is seen as a reaffirmation of national strength and the ability to shape the global economic order according to American interests. The longer-term implications for the global aerospace workforce are also profound. The industry has traditionally been a source of high-skill, high-wage employment in both Europe and the U.S., as well as in emerging markets. The withdrawal of Airbus from the U.S. may accelerate trends toward automation, digitization, and the relocation of jobs to regions with lower labor costs or fewer regulatory barriers. The need to adapt to changing market conditions may lead both Airbus and Boeing to invest in new technologies that fundamentally alter the nature of work in the sector, with implications for employment, skills development, and social stability. The story of Airbus's retreat is also a cautionary tale for other industries. Sectors as varied as automotive, pharmaceuticals, information technology, and energy are all susceptible to the risks of protectionism and regulatory fragmentation. The lesson is clear. In an era of mounting geopolitical tension, no company, no matter how large or successful, can afford to take market access for granted. The need for adaptability, resilience, and a keen understanding of both political and economic trends has never been greater. If you liked this video, please give it a like and subscribe to our channel. Also, could you leave your comments below and tell us? What are your thoughts on Airbus exiting U.S. sales amid tariffs? What comes next? We want to hear from you. Thank you for watching, and see you next time.